Hi, this is Mike Swanson with our first video on how scaling into trades and out of trades can increase the probability of you winning your trade and also your profitability. So let's go ahead and take a look at a few examples of how this would work. This is first going to be pretty basic, and then I'm going to explain how the numbers work out and how it's a much better way to manage your trades. So let's look at this first without scaling. For example, we've showed you that if you sold 0.3 lots at 1.3260 right here, the market went into profit, and then the market aggressively went against you, and let's say it hit your stop up here at 50 pips. So you took a 50 pip loss, and at 0.3 lots, that was a $150 loss. Okay. Now let's take a look at how scaling out of this trade can increase the probability and success of that trade. Here is scaling out. The same exact trade, you sold 0.3 lots at 1.3260. The market went into profit. Now instead of just waiting for it to hit your target or waiting for it to hit your stop or just waiting to exit the whole trade, what you would do is close out part of your position at different levels. So for example, here we closed out 0.1 lots, so a third of our position at 32.40. So we made 20 pips on that part of that trade. And we close out another 0.1, one mini lot at 3200. Now we made 60 pips on that part of our trade. So we made basically $60 on that second part that we closed out. Then the market goes against us, and we close out the remaining position of 0.1 lots at 33.10, and we lose 50 on that part. So see, there's a big difference in here. You can easily see this, that we was able to make some profits while it was going down because we closed out part of our position. When the market then went against us, by the time we was going to lose on the rest of that position, we only had a third of our position left. So if we do the math here, we have sold 32.60, we closed out a third at 32.40, so that's a $20 profit. Then we closed out another third at 3200, that's a $60 profit, and so that's a total right there of $80 in profit. And then the remaining mini lot lost $50. So we netted $30 on this trade that originally, without scaling out, would have lost $150. So this is pretty basic, a basic scaling out method. Now what you're probably asking yourself is, how did I know where to scale out, how much to scale out? I do have some upcoming videos where I'm going to make some more sense out of this, and it's going to actually be something that you definitely are going to want to start using. Let's just take a look at one more example. Okay, here we have a sell trade. Again, a sell trade at 0.3 lots, 1.3190. Then the market went into profit and came back up, and you took a profit this time instead of a loss. So this was closing it out at 3160. That's a 30 pip profit. Now I'm looking at standard pips, not fractional pips, even though this is a 5-digit broker. Now this was a 30 pip profit. Up 3 mini lots would be a $90 profit. So now let's take a look at how we could apply scaling in to a trade and scaling out. Okay, so you can also increase your probability of a trade by scaling into the trade. What that means is, instead of selling the entire 0.3 lots, what you would do is ease into the position or scale into the position. So you would sell 0.1 lots at 31.90, and then we're going to say you add another mini lot at 31.70. You add your last mini lot at 31.50. Now when the market starts to turn up, we're going to scale out, close out one third of our position, one mini lot at 31.10, another mini lot at 31.25, and the remaining mini lot at 31.60. And so now you can see, again, this is going to make us more money than if we did not scale out, and it's going to increase our probability on any given trade, because now our risk to reward ratio is going to be better. Our risk on this initial position, let's say the market were to shoot back up, we would only be in the market with a mini lot, so it wouldn't hurt us as badly as the full 3 mini lots. if we average, the way you would do this, the way to calculate your gain or loss on this trade is you find out what your average open position was and your average close position was. So we would add up these three prices that were our entry, 31.90, 31.70, and 31.50. And then what we would do is that tells us our average entry position at the full 3 mini lots, and then we're going to add up the 3 mini lot close position prices, 31.10, 31.25, and 31.60. So that would mean that our average entry price was 1.3170, and our average exit price was 1.3132. So that means we have a difference of 38 pips. So we made a 38 pip profit on this trade that if we did not use scaling out, we would have only made 30 pips. Now that's not a big difference in this case, in this scenario here, but remember the other advantages. We had less exposure in the market, and we had less exposure as we exited this trade. What if this trade would have shot all the way back up like the other example? We would have already scaled out before that happened and still would have most likely been profitable. So hopefully these examples were simple enough to understand so you can start using scaling out of your trades. You might have heard about scaling out from many different traders and different books and programs and software, but it really does increase the probability of your trades. And as I showed you, even the profitability of each setup. And there's a lot more details that we're going to be covering that go into this. But just like I mentioned, as far as where do you scale out, how much, and we can actually use statistics and different methods to actually find your best stop losses for each of these trades, your best places to take profit, your best places to scale in, whether you should even scale in at all or scale out at all. There's a lot of different things that can go into this, but we'll be covering those things in future videos. So make sure you're coming back, and I'll see you in the next video.